The most recent peace statistics, which the U.S. Department of Labor issued on 16 November, increased by 8 year-over-year, but unexpectedly fell short of forecasts and the prior level. This raises the possibility that U.S. inflation has peaked and provides more proof that it is starting to decline. With the potential of an early dovish turn or perhaps an early rate decrease rising, the Fed's aggressive tightening strategy to restore its own credibility for weak inflation management is starting to run into obstacles. Following the unexpected halt of the US CPI rise in October, which had previously been over 8 for 8 consecutive months, this is another convincing indicator of decreasing inflation growth. Wall Street has since gambled that the Fed would hold off on raising interest rates as a result. After the data was revealed, the Fed's message was likewise pretty apparent. Fed Governor Patrick Harker gave a timely dovish signal when he predicted that the rate rises will be less rapid in the months to come. The Fed should stop raising rates and maintain them at high levels somewhere in 2020-23, rather than taking the chance of over-tightening. Similar dovish remarks had been made in the previous week by at least 4 Fed governors. The signal was given for the Fed to stop raising interest rates and turn amid indications that the U.S. economy is in a recession and the U.S. Treasury Secretary's warning that the U.S. Treasury market may be set to collapse. In fact, the Fed signaled that it will shift the path of interest rate rises in its semi-annual financial stability report, which was issued back on 5 November in a rare acknowledgement of financial stability issues in the U.S. On November 16, the market's estimates of the Fed's interest rate trajectory shifted more to the dove side, with predictions of the end rate decreasing and those of a rate decrease rising. In order to avert a more serious catastrophe, it is obvious that the Fed has now begun to lose some composure and has even panicked. The U.S. 3-month and 10-year bond yield curves had their greatest inversion on November 16 since late 2019, which is interpreted as a warning that the U.S. economy would experience a recession within the next 3 months. The U.S. dollar's depreciation and the decline in U.S. bond rates are now also contributing to this trend. A strong dollar would eventually backfire on the U.S. economy, posing a risk to the U.S. debt load and U.S. business earnings given the U.S. financial market's poisonous mix of high debt, high inflation, high interest rates, and sluggish growth. In response, Michael Barr, the Federal Reserve's vice chairman for financial regulation, declared on November 16 that he was closely monitoring the threats to the U.S. financial system. According to Barr, there are indications of higher volatility and less liquidity in U.S. debt as a result of the Fed's decision to raise interest rates in an effort to combat excessive inflation. A study issued by the U.S. New York Fed on November 16 raised worry about the lack of liquidity in the U.S. Treasury market. A negative feedback loop involving selling excessive volatility and illiquidity is more likely to be set off when liquidity levels are below average. This indicates that even if slowing inflation is encouraging short-term purchase of US treasuries, shorting bets are still hot right now. Data from the U.S. Commodity Futures Trading Commission showed that as of November 15, short holdings in 2-year U.S. bond futures had reached their highest level since 1990. Market concerns about a potential historic U.S. federal debt default have been generated by the combination of a split U.S. Federation that may be a conflict over the budget, debt ceiling, and other issues. Another U.S. government shutdown might result from this, which would again roil the country's financial markets. The period of cheap financing for US debt has come to an end due to the higher currency, which has also caused a crisis in U.S. financial markets and jeopardized the revival of US manufacturing. With expenditure reductions and extensive layoffs as a result, U.S. business leaders and Wall Street are already suffering, which has put the country's credit markets in a tumult. This is why US Treasury Secretary Janet Yellen was once again forthright on November 12 when she stated that a U.S. recession could not be ruled out. The U.S. Treasury market may crash, and the U.S. could face significant financial stability threats. The cost of interest paid on the U.S. federal debt for this purpose would equal to $8 trillion, or 31s of total federal tax receipts in fiscal year 2022, according to US Federal Budget Committee predictions, if the policy rate is hiked to 5.0 in March 2023. The real interest paid may be substantially higher, and as the debt snowball continues to expand, the U.S. would need to borrow an additional $3.08 trillion to cover the enormously higher debt servicing expenses, resulting from a drastic increase in interest rate. U.S. debt is presently reported to be $31.02 trillion in total. The 12-month LIBOR, which is more significant than projections for US interest rates, reached a new high on November 16 of 5.67. It has increased 48.1 this year signaling growing borrowing costs for us government and corporate entities. Larry Summers, a former U.S. Treasury Secretary, thinks that the Fed's aggressive interest rate rise would ultimately lead to the formal start of a U.S. debt crisis and is equivalent to dumping a financial bomb into the U.S. debt powder keg. The trifecta of high debt, high inflation, high interest rates, and sluggish growth is a nuclear bomb for the U.S. financial markets that will finally explode the country's debt. 61 major cities have serious debt issues and lack the funds to pay all of their bills, including pensions, as the cost of debt is now rising in line with interest rates, according to Accounting Truth, the U.S. accounting industry body, which released its most recent survey of the financial situation. Of the 75 most populous cities in the U.S. on November 15, due to this, Wall Street investment banks, economists, and analysts all share the same concern that the over $24 trillion U.S. Treasury market would likely be the catalyst for the next financial crisis in the U.S., resulting in a second Lehman impact. This is a financial time bomb for the U.S. debt market, forcing investors to start doubting the traditional safe haven features of US debt. Wall Street forecaster Peter Schiff said, "Something incredibly unexpected is occurring to the markets in the U.S. economic community at this crucial time." The U.S. version of Exodus is actually being played by thousands of U.S. billionaires, according to data made public by the RAs on November 16. Nearly 8,300 millionaires left Chicago in the 8 months leading up to October 31 in historic numbers, and recently the pace has picked up. As a result, more persons and taxable wealth have been lost than in any other year recorded by the IRRs. Additionally, West Virginia, Louisiana, Hawaii, Mississippi, Alaska, Connecticut, and Wyoming are particularly affected by this exodus of millionaires. The U.S. housing sector is also being choked by skyrocketing mortgage rates, which will have a negative impact on US asset price estimations and cause the quickest pace of drop in US home prices since the subprime mortgage crisis. According to the most recent statistics and evidence, the U.S. housing crisis is intensifying much more quickly than many analysts had predicted, and the housing market boom created by the Fed may be beginning to unravel. The Fed has now issued a warning due to expectations that the housing markets in these three wealthy nations, Canada, New Zealand, and Australia, may crash. Chinese purchasers, private and corporate, have reportedly started to leave the U.S. real estate market ever since the Fed began raising interest rates in March of this year, according to a research released by Real Capital Analytics on November 3. They have collectively sold off US assets worth at least a net of nearly $14 billion during the first 10 months of 2022. In addition to the multiple effects of rising interest rate costs, a cooling real estate market, high inflation, and increased volatility in the U.S. financial markets, the failure of the U.S. economy to achieve a soft landing may make it even more difficult for these affluent U.S. households to improve their financial situation. The departure of these American millionaires appears to be indicating that the U.S. economy has already begun to deteriorate and that the official shroud around the U.S. debt economy has been removed. This explains why the Fed has continued to telegraph a gradual reversal in recent days that may lessen the rate rise despite warnings that U.S. debt will collapse and prospects of a U.S. recession. This is due to the fact that the Federal Reserve's true purpose, as it has been created to this point, is to support the U.S. federal government's funding needs and to advance elite Wall Street interests, including the Fed's own. But if all tells that it's not the end, just listen. New China's insane space station that shocked the world. China become top one, Tiangong space station. I know you want to know more about this story, so just click on this video right here.